Welcome to the Fear and Greed Business Interview. I'm Sean Aylmer. The AI boom has generated huge profits for companies like Nvidia and created tools like ChatGPT that are significantly impacting the way we work. But has it been overhyped? Is it a bubble? And the real benefits for both users and investors will come in the next wave, AI Boom 2.0. Roger Montgomery has written a piece about this very question, suggesting that history is littered with transformational technologies that have benefited society much more than they've benefited shareholders. Roger is the founder and chief investment officer at Montgomery Investment Management, a great supporter of this podcast, offering investors access to a range of managed funds, including equities and private credit. We've spoken to Roger plenty of times on Fear and Greed. He's got more than 3 decades of experience in funds management, equities analysis, investment strategy, trading, stockbroking. As always, this podcast contains general information only, and you should seek professional advice before making investment decisions. Roger Montgomery, welcome back to Fear and Greed.
Great to be with you, Sean, and great to be with everyone.
I mentioned this idea that AI could be one of those technologies that benefits society more than shareholders. What did you mean by that?
Yeah, okay. So if we think about transformational technology of the past, there's lots of examples where we as consumers and in fact society in general benefited enormously, but shareholders didn't do so well. So a classic example in 1886, Carl Benz drove the first Benz patent Motorwagen, which was a horseless carriage. And, you know, if you'd been there at the time, firstly, not a lot of people thought it was going to be transformational at the time.
Yeah.
There was, we had famously Henry Ford, subsequently Henry Ford's lawyer, who said, Mr. Ford, we don't need motor cars, we need faster horses. Mm-hmm. So you may not have picked that it was going to be transformational technology. But even if you did, even if you thought that technology was going to succeed, it would have been impossible to predict which manufacturers were going to win. In the US alone, there have been 1,665 car manufacturers. And
wow.
Yeah, and that's between 1894 and today. And today there's only 4 really that exist of any note. And that is Ford, General Motors, Tesla, and Chrysler. And 2 of those were rescued by a government bailout during the global financial crisis. So they wouldn't exist but for the fact that they were bailed out. And so, the technology has been great. We've all benefited from it. But as shareholders of those businesses, you haven't made great returns. Another example that I can give you is television. Since the late 1940s, there's been 458 manufacturers of TVs globally, and less than 90 exist today. And in the United States, there were 78, and there are now none.
Wow.
And so again, there's a technology that transformed the way we communicate with each other, are entertained and so forth, but shareholders probably didn't do so well. And the last one I'll give you is commercial air travel. Now, Warren Buffett famously said if he'd been at Kitty Hawk when Orville and Wright first took that fateful flight, he once said that he hoped he would have had the presence of mind for the benefit of all future capitalists to have shot him down because they've lost collectively so much money. And I did some numbers using some official data. Between 1945 and 2023, 79 years, the total aggregate profit of commercial air travel in that 79 years has been $20 billion. Now, to put that in perspective, Saudi Aramco makes that in a month. Microsoft makes that in 3 months. It's taken 80 years for airlines to make that, and it could be wiped out, in another pandemic next year. So, collectively, these industries that we all agree they're transformational technologies, they haven't been very successful for their shareholders. And that's the difficulty with new technology. You don't know who's going to win, and collectively, often the consumer benefits, not investors.
Okay, so let's bring this to AI as the transformational technology we're talking about now. I know you've written about thinking about it as upstream and downstream companies. Is that a good way of approaching it?
I think so. So the upstream companies are the pick and shovel suppliers to the gold rush, and we can safely describe the AI boom at the moment is a bit of a gold rush. I'll tell you why in a minute when we look at valuations. But upstream, you've got companies like Nvidia, which everyone knows about, Intel, Qualcomm, Oracle, other semiconductor companies. They're the biggest beneficiaries at the moment of this revolution. The companies that are providing cloud infrastructure, not just data centers, but the technology that links all those data centers together, all the cables and wires and so forth. They're benefiting. And we'll see that when we talk about valuations in a minute. And then downstream, you've got the appliers. These are the companies that are taking the upstream technology and trying to craft a business model that sells it. So it could be B2B or B2C, so business to business or business to consumer. And they're trying to create models that they can charge more for, that we will use and pay for. And what's interesting is that the growth of profits for the downstreamers, the appliers, is starting to slow down. And downstream, you've got, Apple, Alphabet, Meta, Microsoft, IBM, Adobe. They're enhancing their products with AI. Adobe, I think, is a particularly fascinating one, but they're applying the technology to their services. They're enhancing their offers, and they're trying to charge more. What's interesting is the uptake is slowing down, and so is the revenue growth. But this will feed back to the upstreamers because the downstreamers aren't making more money, or the growth isn't what they had planned or what they had hoped for, then they'll be buying less of the upstream services. Now, I don't think, as you said in your introduction, I don't think this is a short-term phenomena. I think AI is here to stay, and I think it's going to be transformative. But I don't necessarily think that the valuations that we're seeing currently, and we can talk about those in a sec, I don't think those valuations are sustainable based on current growth rates.
Stay with me, Roger. We'll be back in a minute. I'm speaking to Roger Montgomery from Montgomery Investment Management. Okay, so those valuations, let's talk about those. Are you talking about for both upstreamers and downstreamers?
Well, it's mostly the downstreamers at the moment where the valuations don't seem to be meeting the growth and the profits. So, for example, there's been a couple of what I would describe as massively hyped valuation uplifts as a result of recent capital raisings. One of them was ChatGPT, which is the dominant capital raising. They closed probably one of the largest funding rounds in history, of certainly Silicon Valley history, and it was a $6.6 billion raising at a $157 billion valuation. So that was the first one. The second one is another competitor in the LLM or the large language model space, and that's a business called Perplexity. Now, let's put some perspective on this. Perplexity in January was valued at $520 million. Okay. By June, the valuation had risen to $3 billion. And they're now looking at doing a fundraising. So they're in talks for a fundraising at the moment at $8 billion. So they've gone from 520 million, less than $1 billion, to $8 billion in 9 months. And in March, their annualized revenue was $10 million.
Wow.
So that's annualized revenue. So that's what they're, now that's grown, and rumors at the moment are that their annualized revenue is about $40 or $50 million. But still, you're talking about an $8 billion valuation on a business that generates revenue per year of $50 million. You go further downstream, what are these LLMs? There are companies now that are taking those LLMs and applying. So they're applying the appliers technology.
Yeah.
So this is like the second derivative or third derivative. The most interesting or the most popular use case at the moment is personal chatbots, companion chatbots. That's what people are using this software for the most in terms of a revenue generation model that is the most popular at the moment or growing the fastest. So these are people who are maybe lonely or unable to go outside and unable to talk to people, and for legitimate reasons want to use companion bots and that seems to be the most popular use case. They're not big. We're not talking about massive, transformational use of this technology right now.
So, as an investor, let's bring it back to investors. How does an investor who wants to get in on the AI boom, whatever that is, how do they think about it? How do they do it?
Well, there's probably a few ways to think about it. The way or the framework I would use to be thinking about it is in terms of phases, the way this technology rolls out. So phase one is Nvidia, right? And then phase two is, which might not be today, and it might not be next year. It could be in 2 or 3 years' time. Phase two are the companies that take the technology and apply it directly to generate revenue from existing services. We've described those, the Adobes of the world, right? So if you're using Adobe Photoshop, it becomes much easier to use if it's enhanced by AI. Or Netflix might have an AI version of a subscription that actually helps me from searching for a movie that I saw 5 years ago. What was that movie again, Sean? It had that guy in it. That guy with I can't even remember his name. Maybe AI helps me find that movie, and that makes it just simpler to use. And if I want that service, I've got to pay an extra $10 a month to get it. And you know what? That's going to be much simpler, save me a lot of time and a lot of arguments at home about what we're going to watch tonight. So that's phase two. And that's not really happening yet in a meaningful way. We're not seeing rapid increases in revenue growth from the adoption of Adobe's AI enhanced version. And then there are versions like, there's Meta and Meta's version of, Facebook, which is already AI enhanced. No one's paying any more for it. There's no revenue uplift from it. So that's phase two, and that will take time to evolve. And then phase three is the final phase, and that takes years to roll out. And that's where, Sean, you and I doing this today is enhanced by AI. And that's where everything's enhanced by AI. If indeed AI is going to be that good that it enhances everything. There's a real debate going on in the AI community at the moment, whether AI, LLMs, large language models, ChatGPT, becomes this general intelligence, artificial general intelligence, which is AGI. And there are those who are arguing that in order for large language models to evolve into AGI, which is what everyone's worried about, or a lot of people are worried about, the whole idea that AI destroys humanity. In order for that to happen, there are those who argue there's not enough energy on Earth to power those large language models enough to be able to get that going. So, we're a long way by some accounts from a world where large language models, forget about AGI, where large language models are helping us in everything. That's not phase one. That's not even phase two. That's phase three, and that's some years away. And so for investors, the prices you're paying today are factoring in that happening right now. And all you need is a bump in the road like China, circumnavigating Taiwan permanently, annexing Taiwan and saying to the US, come and get me. That could be enough for all of the hype in AI to correct violently. And then, then you're in a better position to say, it's worth taking the risk now. Yes, I think phase three is going to happen. I don't know when, but now I'm paying a much cheaper price, and it's worth doing now.
The moral of the story, we're out of time now, but the moral of the story, Roger, is buyer beware if you're going to jump into the AI story.
Yeah, look, I think there are going to be winners and there are going to be losers. Number one, really hard to pick who they are. And number two, you pay too high a price, even if you get it right, you could end up with a poor return.
Roger, thank you for talking to Fear and Greed.
Always a pleasure, Sean. Thanks for your time.
That was Roger Montgomery, founder and chief investment officer at Montgomery Investment Management, a great supporter of this podcast. Visit Montinvest, Montinvest, montinvest.com for more information or sign up for Roger's Insights at rogermontgomery.com. This is the Fear and Greed business interview. Remember, this is general information only, and you should seek professional advice before making investment decisions. Join us every morning for the full episode of Fear and Greed, daily business news for people who make their own decisions. I'm Sean Aylmer. Enjoy your day.